You invest in Indian stocks, you track Nifty, you follow Indian news. But here is the uncomfortable truth. What happens in the US can hit your portfolio before Indian headlines react. So tell me honestly, are you watching global risk or just the local price? This is the blind spot most retail investors have because markets are connected through capital flows. And by the end of this video, you will understand how US yields affect the Indian stocks, why the dollar index matters more than you think, how global tech businesses transmit locally, and what signal tells you India can decouple or not. Stay till the final section because that's where the illusion of isolation breaks. Money doesn't belong to one country. Global funds allocate capital based on risk adjusted return, currency stability, bond yields, growth outlook. If the US bond yields rise, US assets become more attractive. Emerging markets lose relative appeal. If dollar strengthens, capital rotates towards safety. Now that rotation pressures the emerging market, including India. This is mechanical, not emotional. When the dollar index rises, emerging market currencies weaken. FI's dollar returns shrink. Risk appetite cools. If the rupee weakens while the dollar rises, double pressure builds. Dollar strength tightens the global liquidity. Tighter liquidity increases the volatility. That's why dollar matters. Not because of forex trading, but because of capital pricing. Indian IT revenue is linked to global clients. If the US tech slows, Indian IT feels it. If Nasdaq falls sharply, risk appetite globally shrinks. That affects the sentiment. Sentiment affects the valuation. Valuation affects the price. So when US markets wobble, Indian markets react. Not instantly, but consistently. So, can India decouple? Yes, but selectively. Domestic demand is strong, banking system stable, and consumption is resilient. But capital markets are still global. If global liquidity tightens, India feels the volatility. If global liquidity expands, India rallies faster. Decoupling works for economy, not always for stock prices. That's the main nuance. So, if the US yields rise, dollar strengthens, oil stays elevated, and rupee weakens, then macro pressure stacks. Stacked pressure increases the correlation. Correlation reduces the diversification benefit. Reduced diversification increases the volatility. This is risk clustering. Markets rarely fall from one shock. They fall when global and local pressures align. So, what do smart investors watch? They track the US 10-year yield, dollar index, Nasdaq performance, global ETF flows, rupee stability. They don't wait for Indian headlines because by then price has already reacted. Global risk transmits quietly, then loudly. If you have been watching Indian charts, expand your lens because markets are global chessboards. Moves in one corner affect the another one. Most investors react locally, few anticipate globally. If you want to understand the risk before it crosses borders, subscribe because capitals move first, headlines follow, and prices react.